Ladies and gentlemen, please take your seats as we have another knowledge-packed session. The leading experts of our next panel, Economic Outlook, a Domino symphony of challenges and opportunities, will explore the latest news of commodity markets and how to predict the unpredictable in a turbulent landscape. Please welcome on stage our moderator, Mr. Ahmed Allam, financial expert at His Highness the Ruler's Court of Dubai, who will introduce his panel. Ahmed, dear speakers, welcome.
Thank you very much. Good afternoon, everyone. I would like to welcome you all to this amazing panel. Actually, we have so special guests and panels today, where we are going to have both economic and geopolitical side discussion. And based on the experience and based on the panelists today, I expect to have so special discussion and so insightful discussion regarding the geopolitical and economic outlook. So let me introduce my esteemed guest, Mazen Salhab. He is the Chief Market Strategist at BDSwiss Middle East and North Africa. Thank you so much for joining us, Mazen. Dr. Lemand, he is the co-founder and Chief Executive Officer of Neovision Wealth Management. He is also an independent non-executive director of multiple companies and fund in various jurisdictions. Thank you for joining us, Mazen. And last but not least, João Belo Branco. He is the Global Head of Wealth and Trading in Emirates NBD. Great to have you, João. I will give the chance for my guests to introduce their business and what they are doing in a brief. We can start from Mazen.
Thank you very much, Mr. Ahmed, for having me today, and thank you for everyone who is being here. I think, as you may know, 2023 was really very good year in terms of in the global markets, and I think it was one of the best year as well in GCC, mainly Saudi Arabia and UAE. 2024, I don't think it will be the same. So I'm expecting more challenges ahead, and of course, there'll be different challenges as well. BDSwiss is a Swiss-based company actually, and in terms of the global markets, you know, like everyone now, we are living in this changing world, and so much focusing on technology and AI solutions. So I think it's the right time for everyone to be here in this region in GCC.
Thank you, Mazen. Dr. Ryan.
Yes. Thank you, Dr. Ahmed. Good afternoon, everyone. So it's great to be here. Neovision Wealth Management is a company based out of Abu Dhabi Global Market, the financial free zone of Abu Dhabi. It has two verticals, two services. The first one is wealth management, where we cater for the high net worth, ultra high net worth individuals and family offices on all levels, whatever they want to buy, whether it's a private hotel in Paris or just Google stocks. We can do everything. We can advise. We can do discretionary portfolio management. The second vertical is creating funds. So we offer funds as a service for families, for fund sponsors, for foreign fund managers, if they wish to have a presence in the UAE. We create white-labeled funds for them here in the UAE. We register them with the regulator so they can market for these funds in the UAE. We can do also SPVs. We can do foundations. We can do all types of structures for sponsors and professional families.
It's our pleasure to have you, Dr. João, can you introduce yourself and your business?
Can everyone hear me? Yeah, I guess so. Okay, thanks a lot, Dr. Ahmed, for having me here. Thanks, Mazen and Ryan, to doing this with me. So I'm João Branco. I'm in Live. So Live is one branch of Emirates NBD. It's a mobile banking app, so we're fully digital. And I joined them more or less 1 year ago to start developing their wealth proposition. So I'm really happy to be there. It's great to be here with you all. Just a caveat, since Leaf doesn't do any advisory or wealth management services, all the views that I'm going to say here today are purely my own and not the bank's. Thank you.
Thank you for joining us, João. Actually, all of us agree that the economy is like the weather. No one can precisely predict it. Even the geopolitical tension around the globe result in a drop in the economic confidence, actually. So the last period witnessed too much accelerated economic events we can consider, such as even also the geopolitical events such as the war between Russia and Ukraine, the war in Gaza, recently the war in Yemen, and the slowdown of the China's economy, in addition to the emergence of the BRICS blocs. That's why some economic experts mentioned that we are at the most dangerous time we have seen in the last decades. And anyone watching the news realized that most billionaires, most analysts can warn us about that the financial crisis is around the corner. So in no specific order, let me start with you, Dr. Ryan. You know that the monetary system is considered like the lifeblood of the economy. And recently, we observed that there is too much intervention from the government and central bank in the economy, however, by supplying too much money in the system or even increasing the fund interest rate. From your own perspective, to what extent do you think that the government and central bank succeed to achieve their objective to control the inflation and push the economy to the normal position?
Thank you very much. So I assume you're going to be talking about the U.S. because the U.S. it's basically the elephant in the room, if I may say. So indeed, the Federal Reserve, since the financial crisis in 2008, have succeeded in suppressing any slowdown, any recession. Recently, we've seen with the inflation, they succeeded also at controlling inflation. So inflation has dropped to 3.5%. So at the first look, it looks like a success. But at what cost? This is the problem. It's the cost. One, it's the monetary policy, and then you have the fiscal policy. So monetary policy has been restrictive. So when monetary policy is restrictive, the economy is supposed to slow down, and this is what drops inflation. So when the economy slows down, we see unemployment rise, right? This didn't happen in the United States. You know why? And I'm sure all of you have seen many international companies, very large companies in the US, banks, tech, have announced massive layoffs, right? But we have not seen unemployment rise because this has been offset by government hiring. The government has been spending astronomical amounts of money in fiscal spending, one of which was hiring government employees. As we know, government employees are very essential to a functioning government. However, they do not produce a product and they do not produce an economic service that adds to the GDP. So all of these layoffs from these private companies have been offset by the government. So the result is a very big government deficit of more than $2 trillion. We're seeing the government debt of the US exceeding $35 trillion. I mean, these are astronomical amounts, okay? Now, the problem structurally with the United States is its economy. 70% of its GDP is consumption, okay? It's basically consumption. So consumption that is based on debt, because as you know, consumers in the US, they borrow to spend. So their house increased in value from $200,000 to $250,000. They extract the equity of $50,000 and they go to the mall and they buy a TV. It's an amazing economy for a manufacturing company, right? Everyone wants to sell stuff in the US because the US consumers like to consume. So you would expect that the US is also a manufacturer. Well, no, they are not a manufacturer. Only 11% of the GDP is manufacturing. Who does the manufacturing? It's China. And this is why for China, the US economy and consumption is very, very important. So structurally today, the US is very vulnerable, not only because of its debt. Debt is okay, we can control it. Deficit is controllable as well. So Japan has lived with a debt to GDP of 250% until now. The problem is structurally, the economy is only based on consumption. It's an economy that is not manufacturing today. And all of this rally that we've seen in 2023 is based on artificial intelligence, as you know. The whole stock market got dragged by 7 stocks, and it's on the back of GBT, which is artificial intelligence. We are very far from mass adoption of artificial intelligence. Maybe we can speak about that.
Sure.
Thank you.
Awesome, Dr. Ryan. Actually, you prove every time that you have your own point of view to explain everything. So thank you very much. Mazen, let me ask you the same question, but in a different approach. And since Dr. Ryan talked about the Federal Reserve and talk about the US economy, so we observed that the Fed succeed in containing the increased inflation rate, and it succeed to reduce the inflation rate from 9% in June 22 to almost 3.2% nowadays. From your own perspective, to what extent did the Fed succeed in containing the inflation rate, and do you expect there is other cycle of inflation in the short term, and what is your prediction about the fund interest rate on or in 2024?
Thank you, Dr. Ahmed, for this question. What we are already know that the inflation was and still very vicious. It is very sticky. Inflation target that has been set by central banks at 2%. I think right now what the central bank should do is to change this target. It's not practical anymore where we are living in this environment and we are fighting to get the inflation back to 2%, and it will never happen, at least in the that's 1 or 2 years. So the thing is, we relied, the global economy, governments relied on the central banks since the global financial crisis 2008, and the governments were somehow lazy in implementing the structural reforms that the economy needs. So what we have done, that we relied on cheap economy, cheap money, that the central banks printed, and then we have higher inflation. And by the way, inflation happened, increased to 9%. It's not only because of the corona. It's not only because of the supply chain disruption. It's because of the cheap money that has been running in the system. So we are already in a cheap money environment, low interest rate, zero interest rate actually since 2008. So that's why the inflation was sticky, and it will remain sticky and vicious. Yes, your question is very important, Dr. Ahmed, because we are expecting that the inflation is not going back to 2% in 2024 and even 2025 unless we have recession or we have a real drop in economy. So to have inflation at 2% that has been set by central banks, I think this needs economy to be very weak, or the stock market will collapse, because we need to cut the prices of the assets in order for inflation to be back to 2%. This is the only solution, because right now, with what's going on in the world, with the geopolitical tensions, the gains of oil in the last few days are giving very important message that the inflation is here to stay. So yes, energy is not the only component in CPI index, in inflation index. We need food, we need energy, we need housing. But the thing is, if oil price keeps increasing, then we have to expect that the rates are unlikely to be cut in 2024, or let's say what the markets have seen before is unrealistic reading. It's a prejudgment which is unlikely to happen. So if the oil keeps increasing, the Federal Reserve is unlikely to cut the rate not before the third quarter. Now the markets expected in April. I doubt. I doubt. We have 5.5 interest rate in America. I don't expect to cut by more than 0.5 in 2024 if the situation goes on.
Perfect, amazing. So, João, I will start with you from what Mr. Mazen mentioned now. He referred to the cheap money, and he referred that the interest rate, it will not go down at least after a few years, if I understand it in a proper way. So, we all know that after 2008 financial crash, the interest rate start to decrease to almost 0%. And the real interest rate was negative, in fact. So from your perspective, do you think that the easy money environment, I mean that the free money based on the very low interest rate, it will not exist on the short or at least the medium term?
Yeah, I think like Mazen was saying, like central banks are quite careful about saying that they're going to decrease the interest rates. You have the ECB who just came out saying that they might decrease them in the summer, but we're speaking about like maximum not even 1%, right? So this won't really like bring us to a 0% interest rate that we had like 5-10 years ago. So I think until that happens, we're still looking at a long-term or medium-term high interest rate in the more or less range that we have right now, depending on the geography. And this, I guess, it's the US, it's Europe. We just came out with that, and that impacts the GCC as well, and the UAE specifically, and the UAE market, which obviously is pegged to the dollar.
Awesome. Dr. Ryan was still talking about the interest rate and fund interest rate, especially announced by the Federal Reserve. So you know that there is a significant relation between the fund interest rate and the performance of the financial market. I would like to ask you how this relation work, and did this relation go on the proper way in 2023?
The short answer is absolutely no. When I didn't have so much white hair, the relationship was as follows. When the Fed increased rates, stock markets dropped because this would mean that the economy will slow down. Unfortunately today, and since 2008, the adoption of ZIRP, zero interest rate policy, this relationship has reversed. So today, bad news are good news for the stock market. So when the economy is slowing down and the Fed is increasing rates, this is actually good because that means the Federal Reserve, once the economy slows down, will drop rates, will go back to zero interest rates, and this is very good for companies. They can borrow, they can buy back their stock, they can invest, right? They can expand. So it's a very weird relationship. Now, in 2023, we were very close to this abnormal relationship breaking down. And then something magical happened in 2023. It's called ChatGPT, if you remember. Stock markets were dropping. S&P 500 dropped to 3,500, if I'm not mistaken. And it was very wobbly. And then out of the blue, we had something called ChatGPT AI, where we had the promise that this will transform our lives. So let me take you back to year 2000. In year 2000, I was a very young person working as a junior in investing in stock markets. And then the internet came to be. Imagine there's no internet, and suddenly there's internet. So there's a company called Cisco, which I'm sure most of you have heard of. Cisco was basically the only company manufacturing routers back in year 2000. Literally the only one. Imagine that. Internets need routers, right? You cannot have internet at home without routers. Companies need routers. So we thought Cisco is going to go to the moon. Why? Because everyone is going to use internet. What happened? Internet took roughly 20 years to be adopted, close to 80%. Adoption is something very slow. So today the rally we've seen on, or driven by AI, assumes that adoption of AI will be completely widely spread over the next 2 years. So let me engage you. Please help me. By the show of hands, tell me if you use AI, whether ChatGPT, Bard, Copilot by Microsoft, any of these, multiple times a day. Not once a week, multiple times a day. Please raise your hand if you use AI multiple times a day. Okay, that's 20% of the audience. Okay? I'm sure you find mistakes when you use AI and you have to check it, you have to double check it and correct it. It's not yet ready. This will take time. So today what's happening is that Microsoft, Google, NVIDIA, all of them are investing massively into AI. AI is a very capital intensive activity or sector, very capital intensive. If they do not get returns on this, they will start scaling back. And this is what we expected to happen, is that they will start cutting back because adoption of AI is not widely spread yet. Companies are laying off employees because they think they can replace a financial analyst with AI. I'm telling you, it's very far. And I know a thing or two about this. I'm not saying I'm the smartest, but I have a PhD in neural networks. Neural networks is what AI is. So today, ChatGPT, the model is based on a mathematical model called neural networks. Okay? We couldn't do it 20 years ago because computers were not ready. Today, computers can do it.
Amazing, awesome. So, Mazen, talking about the stock market, we saw recently that the stock market is once again pumping up.
Correct.
So, do you think that we are in a major bubble now? Or do you think that the tech bubble in 2021% is over already?
I doubt this bubble will end anytime soon, because right now, if we read the metrics of the US stocks, mainly in the tech sector, it's too much high and it's overvalued. So what does that mean? It means that the stock price is very expensive. So does it really reflect the reality of the economy? I doubt. This is by the way, this is a very big dilemma in the markets right now. We have a very big gap between Wall Street or financial market and the real economy, day-to-day market. This is very big dilemma in advanced economies right now, and it's unlikely to be solved anytime soon. We have a booming stock market, but doesn't mean we're going to have a very strong economy, because the stock market has been built on debt, has been built on cheap money, and has been built on buying the future. This is very important, because what markets have done in the last 3 months, in the last quarter of 2023, they bought the future. They thought that, okay, we're going to have lower interest rate, so we can bet on higher stocks, we can bet on more cheap money to the system, which is incorrect. So I doubt this bubble will end anytime soon, and I'm really curious about the outcome, because I don't think it will end in a very good way. I doubt.
Okay, that's cool.
It's not scary.
So
but
we have to get ready, huh?
We have to get ready for a correction, not because we have a difference between being in a crisis time and being like correction. So the markets, yes, will be corrected anytime soon. But this doesn't mean we are in crisis. No, it's not a crisis. It is correction that may be massive, could be massive.
Perfect. Okay, moving to other type of assets, João. If we talk about the real estate and housing, we observed that the mortgage interest rate has increased aggressively recently. And however this increasing, we observe that the price of houses is keep increasing. So do you think that we are facing a bubble same like what we faced in 2008, for example? And what is your advice if I put a house or a property few years ago? Shall I sell it now, or it's a time to buy?
Yeah, that's a very good question, and I mean I agree, it's a bit counter nature that interest rates are going up, and obviously then the mortgages also go up, and that the price of the houses continues going up. You also have to think about where geographically you are and which market you're speaking about. So we can focus, for example, on the UAE and the US market, where you've seen like a huge increase in last year in terms of housing prices, even though interest rates are high and people are paying high mortgages. Now, which kind of houses, which kind of population is really driving these prices above and beyond? And why is that market growing? So I guess in the UAE, you're seeing a lot of expats coming in, and a lot of these wealthy expats that come from all over the world. In many cases, either do not access to credit to buy their houses, or they'll have to access credit anyway because they're moving here, they need to buy a house, so they get credit even though it's expensive credit. Whereas in the US, the situation is a bit different. There's just a shortage of supply in the housing market. There's no family homes. So construction companies don't have enough supply to give to the demand that they have. So you still see like house prices going up because people just have just to run to buy those houses, and the prices go up because of that, independently of the interest rate being high and the mortgages being expensive.
Okay, awesome. So, Dr. Ryan, moving to one of the most significant market, which is the oil and energy market. You know, as the result of the war between Russia and Ukraine, it has a significant impact on the world as it creates a profound economy or a profound economic change, actually. So, how does this replacement of Russia's oil from the Western country to the Eastern country, how such change reflect the deep change of the profound economy?
So, oil is quite tricky. So real oil markets, real actual transactions,
Make it
real oil transactions are only 1/30 of speculative trading on oil. So if you look at derivative trading of oil, it's 30 times the physical market. So there's a lot of speculation happening on oil. Now, if you look at oil fundamentally, there has been radical changes that happened over 2022 and 2023, as you mentioned. There's specifically on the US side. The US side is not importing oil anymore. It's self-sufficient, and it's also now exporting. Gas is no longer exported from Russia to Europe. There has to be a replacement, okay? As well as for oil. Now, the problem with oil is replacement. There's something called replacement capex. So when you have an oil field and there's an oil well, an oil well lasts a few months only, and then it gets depleted. And then you have to drill another oil to replace it. This is called replacement capex. This is for you to sustain a very specific production. This is not new explorations. So replacement capex, just replacing the oils that are getting depleted to keep your production, is 85% of capital expenditures in general. So only 15% is exploration. Now, if you look at how much capital expenditures have been made by countries' oil companies, it's 40% less than what it was 15 or 20 years ago. So sooner or later, we will have a shortage of oil production. So today, if you look at multiple countries, like the US, they're producing at the absolute maximum capacity. Maximum. If China's economy today turns around and China starts buying oil like it used to before, we will have a shortage of oil. If you look at airlines, airlines have still not come back to this same capacity as pre-pandemic. Sorry. Once they do, their demand for oil will rise up again. So our base case scenario, if China's economy picks up, is an oil production shortage because there's not enough capital expenditures being made on oil.
So we have to pray that China will not come on the track again, huh?
Well, pray, yeah.
Okay. Mazen, you know, all of us know that there is a severe sanctions from the Western country on the Russia, and specifically Russia's oil. How do these sanctions on the Russia's oil achieve its objectives? And do you think that such sanctions have failed and backfire toward the Western countries?
First of all, we need China to be back on the track, actually, because growth of China is very essential. I think the sanctions by the West on Russia were not fully, like effective as the West expected before. You know, the price of oil it's an irony, actually, because WTI and the Brent fell by almost 10% in 2023. But the price of Ural oil, which is a Russian benchmark, increased by 15%. So Russia is still making money, making a lot of money by exporting oil to many different countries. By the way, Russia has very good connections and good relationship with China, India, and a lot of Asian countries. So yes, the Russian oil is still going on, has not been fully affected by the sanctions, and even for the gas. So that's why I think, no, the sanctions have not really worked well as the West expected. And 2022 and 2023, I mean, was not easy for the West. Yes, now, as the war goes on, the West is trying to find alternatives, to find more ways to less dependent on Russian oil. But I doubt that they would be able. And I think as long as the war goes on, at the end of the day, they will be forced to sit together and to find a political solution. Because at the end of the day, you cannot stay like that. I mean, war will never like go forever, and having this negative impact on the West itself. The growth of Russia was not good. In terms of growth, economic growth, yes, was a little bit weak, but the price of oil is still making billions of dollars for the Russian government every year. So did they stop? No, they failed, almost. But the thing is, that's why I think what happened in 2023, and as the geopolitical tensions in the Middle East increased again, this is going to have very political consequences on the war between Russia and Ukraine as well in 2024. So I think Russia will, and of course the United States of America and mainly Germany as well, will try to find. I'm not sure if they will be able to find now. I mean, the first half of 2024. No, they will not. But at the end of the day, Russia is still making money.
Russia find other market, and it's the biggest partner now for Russia. It's become China, India, and Turkey, especially related to the energy and the oil market.
Absolutely. I mean, yes, Russian exports were mainly to Germany and to West countries for gas, mainly for natural gas. But now, Russia, okay, let's do one thing. Let's find solutions. Let's find alternatives. So now, India is more pragmatic than any other countries. And by the way, India is a very close ally to America. But still, India is importing millions of barrels from Russian oil every year, every day. The same for Malaysia, the same for China. China, of course, like is a close ally. But the thing is, even if the West decided to cut the oil from Russia, it doesn't mean that Russia is, let's say, is stopping from exporting oil. And the same, by the way, the same scenario happens for Iran, by the way, because now America has imposed very tough sanctions on Iran, and Iran still able to export 2 to 3 million barrels a day indirectly in the black market.
Amazing, amazing. Okay, João, I know that you was participating or deeply participating in the COP28 regarding the climate change. And there is some specific outcomes of this summit. One of the resolution is regarding rapid shift from the fossil fuel to the clean energy. from your perspective, how could such resolution impact the oil energy market in the nearest future?
Yeah, so that's a very good question, and obviously COP28 has been existing for many years, and like all the countries have been working together for that transition throughout time. I think what happened now, and specific for this COP28, it's deeply related with what you just mentioned and what Mazen just mentioned about how the shortage in supply and the sanctions in Russia really pushed some of the countries that are now find themselves without gas and oil production provided by Russia. They just find themselves without anywhere else to go, with besides like finding like new ways and investing a lot of money to find renewable energies and more sustainable practices to produce their energy, even if from fossil fuels. So what I think happened in this COP28 that's very important is that a lot of the countries that before would go there, yes, would agree, I'm changing like my agenda in terms of sustainability, I'm doing this, I'm doing that, and then things didn't really happen or didn't happen the way that, or as fast as it was expected. What you now find is that a lot of people, a lot of countries are coming to the table with actual plans to change the whole policy that they have in terms of energy production, energy supply, the amounts that they're investing in sustainable energy, and basically how they now also interact with other countries based on their political energy agenda, which they now use to deal with other countries and to negotiate with other countries.
Awesome, awesome. Dr. Ann, you know that the psychological behavior play very important role in the performance of the stock market and financial market. I remember I read that Isaac Newton said before that I can calculate how things moving in the sky, not how crazy people act. FOMO phenomenon, or fear of missing out, this phenomenon, how could such phenomenon affect the performance of the financial market?
It affects it greatly, and specifically in the United States. 40% of stock market trading in the US is done by retail investors. Retail investors are generally followers. So they look at very basic news. We have Bloomberg. We have very advanced access to data and news. Retail investors don't. So they are followers. And they can be tricked into coming into certain stocks. And this is precisely what happened with the tech stocks in the US. The majority of it has been retail investors driving it. So yes, investor psychology has played a very big role, and that behavior is repetitive. From the tulip bubble in the Netherlands 300 years ago, it's exactly the same behavior. This is when one bulb of tulip in the Netherlands could buy you a house. And then the price dropped to basically the equivalent of $2. So this was psychological behavior. It's the fear of missing out. I don't want to miss out this price action. So this is what's driving the US markets. This happened in multiple places as well. We lived it here in Dubai. In Dubai, before the financial crisis, there was some crazy trades happening, and basically driven by retail trades. So this psychology has to be converted into funds, into collective investment schemes and portfolios, rather than investing yourself. You don't treat yourself, you go to a doctor. So it's better to go to professionals to manage your money.
As we're running out of time, my last question for all my esteemed guests. Let's assume that I'm not this too much wealthy guy, and I have $100,000, for example, and I would like to put it in somewhere I am not going to lose it. So, what is your advice to collect a specific kind of assets to be included in my portfolio in 2024, Mazen?
This is a very good question, Dr. Ahmed. I think being in the Middle East right now is good. But anyway, now you can have the magic word, diversification. So everyone should diversify. But the thing is, you have to set like 20 in commodity, 20% of your portfolio in commodities, like gold, basically, tangible assets. Make it tangible. And now, since the interest rate remains high, so the bank is giving you very easy return on yearly basis, 5 to 6%, which is good, but don't make more than 10 to 20% of your portfolio. Tech sector, yeah, why not? Tech sector, okay, but be specific, be selective, not AI. Avoid AI right now because I don't think this is right. It's very exaggerated, as Dr. Ryan said. What else? Dollar somehow is still okay because the interest rate is still giving a little bit value, but not after 2024. Bond, I like bonds actually, but I'm not sure if I want to buy the short-term bond, make it long, because Abu Dhabi bonds, for example, or Saudi bonds have a very amazing, very high credit rating, like 5 years, 10 years, even in the US, are giving good return.
Thank you, Mazen. Dr. Ryan.
So I would advise 40% cash sitting in a fixed deposit at the bank with a 12 months maturity, but nothing less than 5%. This will lower the volatility of the portfolio. The remaining 60%, I would split them 60-40, 60% on bonds, diversified. As Mr. Mazen mentioned, you have some amazing bonds in the region that you can invest in. You have some US treasuries as well. On the equity side, we advise GCC stocks, diversified, Brazilian stocks, Japanese stocks, and Indian stocks. And obviously gold, 2% of the portfolio.
Okay, Mr. João.
Yeah, I guess I don't really like to give advice, but I will say what I'll definitely not put at this moment. I think those tech stocks that Ryan spoke in the beginning, like definitely overvalued. Like the SP 500 grew only because of those stocks. So you have a lot of undervalued stocks in other sectors, even in the US market, which you probably can invest that may go up. And then gold, yes, always have it in your portfolio, but due to the recent political events, it's probably a bit overvalued as well, so you may want to be careful on that side. And then high-risk bonds. So you have a lot of credit going around, like the interest rates are really high. Maybe some corporates are going to default. So be careful about your risky bonds that although have high interest rates, may not go so well in the next few years while interest rates are high.
Okay, perfect. Mazen, Ryan, João, I would like to thank you all for sharing your amazing and thoughtful and opinion. Thank you so much. I would like to give special thanks for my audience to joining us today, and I would like you to enjoy the rest of the conference. Thank you very much.
Thank you, guys. Thank you, Dr. Ahmed. Thank you.
Thank you very much.